Good afternoon, everyone. So, a quick story before I start my presentation. About a year ago, I lost $5,000 in a crypto hack. I had done my homework. I had been working in the sector for the past 4 years, and yet, due to some basic security fails, I woke up one morning with my account entirely empty. And the worst part wasn't even the money itself, it was realizing that there was nobody that I could call, no banks, no insurance, no government. It was just gone. That's when I started getting into this topic further. Because what I learned is that in crypto, the risk framework the platform builds is literally the only thing protecting your money. There's no second line of defense. So today, I want to walk you through what a serious framework actually looks like using Binance as my global case and the UAE regulators as my legal anchor. Now, just to set the scene, Bitcoin's about three and a half times more volatile than the stock market. Hackers stole over 2 billion from crypto this year alone. The Bybit hack in February, $1.5 million gone in a single attack. And here's my main argument. Crypto risk isn't some weird new species of risk. It's the same risk banks deal with, just faster, irreversible, and with nobody to bail you out. And let me show you why. Now, here's the agenda. We'll be starting with context and regulation. Then we'll be going on to the framework. And thereafter, I will explain 10 risks that, that 10 specific risks. And then I'll show you three math models that we'll closely look into and how it could be practiced into exchanges. Let's get started. Here's something most people get wrong. They look at Binance or Coinbase and think it's a website where I buy Bitcoin. That's not what it is. A modern crypto exchange does five different jobs at the same time. It matches buyers and sellers. That's what a stock exchange does. It holds your money. That's what a bank does. It offers futures and options. That's what derivative dealers do. It lends money. That's what credit firms do. And it runs payments around the clock. It's a 24/7 running market. Now, traditional finance keep these jobs separate. Different companies, different regulator, walls in between. But crypto exchanges, they fuse all five into one piece of software sitting open on the internet. And that is the problem. Because when one thing breaks, everything breaks at the same time. There are no walls. That's what the red strip at the bottom is saying. The risks aren't independent, they're correlated by design. So, how is this actually different from banking? There are six dimensions that are mentioned on this table. For now, I'll just focus on three. First and foremost, volatility. The stock market moves about 15% a year, and Bitcoin moves 54%. That alone changes everything. But this row is the one that really matters backstop. When Silicon Valley Bank collapsed in March 2023, the Fed had emergency liquidity out within 48 hours. Depositors got their money back. When FTX collapsed in November 2022, there was nothing. No central bank, no insurance, no rescue. The whole thing was over in 72 hours, and $1 billion in customer funds just vanished. The last row, operating hours. Banks close, open. Markets close and open. But crypto, it never closes. There are no weekends, no holidays. A 24/7 running market with no circuit breakers when things get crazy. So it's the same categories of risk you'd see in any bank, but everything happens on faster, like it's on steroids. You can't undo anything, and nobody's coming to save you, which is why regulation is so important. So, how do you regulate something like this? The UAE has honestly the best answer I've found yet. Three regulators working together. And the most important one is VARA, which I had the opportunity to learn about in my last trimester. The Virtual Assets Regulatory Authority is set up in Dubai in 2022. Is the first regulator in the world dedicated only to crypto, not a sub department, not a side thing. It's the only job is is virtual assets. Four rules from VARA I want you to remember are: exchanges need at least 1.5 million dirhams in capital. They need cash on hand equal to at least 1.2 times their monthly expenses or operational expenses. They have They have to hold 100% of customers' assets, reserves, one on one, no playing with customer funds, and it gets audited twice a year. And retail customers can't borrow more than five times their balance. Not like in our exchanges where you can take 100 times your leverage, which is, in my opinion, is nonsense. Then Abu Dhabi has its own setup called ADGM, which uses um, English laws, and they've outright banned privacy coins and algorithmic stable coins. That's a direct response to the Terra collapse that had happened. And the result of this, after FTX blew up, after Binance got hit with their massive US settlement, every serious exchange needed a clean jurisdiction to operate from. And I think UAE was most of their picks, including Binance, OKX, Crypto.com, Karkin, and that's really not a coincidence. Now, moving on to the framework. This is the international standard for risk management, period. Any industry can use it. Five steps left to right. Let's go through them. First, figure out what your business actually does and who's affected. Then identify what could go wrong and analyze it. How likely, how bad can the things get? Then decide what to do, avoid it, reduce it, transfer it through insurances, or just accept it. And finally, monitor and report. For crypto, the big adaptation is that last step. In a bank, monitoring means quarterly board meetings. In crypto, monitoring means a real time dashboard since it's a 24-hour running market. It never sleeps. So the risk team can't sleep either. Now, and this is important, ISO 31000 by itself isn't enough. It gives you the structure, but not the actual numbers. So you have to layer it with Basel 3 for capital rules, IFRS 9 for credit losses, NIST for cybersecurity, and VARA's specific rule books for legal compliances. They have four, actually, they have 14 overall, but there are four main rule books. That layering is what separates a real framework from a checklist. So, what are we actually managing? There are 10 risks sorted into three groups, and I'll go ahead with the financial risks first. That includes market risk, credit risks, liquidity, things that hit your balance sheet. Then we have non financial risks, including operational, legal, reputational, things that hit your operations or your trust. And lastly, crypto native risks, technology, geopolitics, terrorism financing, money laundering. These are the ones that don't really exist in traditional financing. Look at the colors. Five out of these 10 are rated extreme or high. A normal bank has maybe two or three in that zone. Crypto has five. That's the whole story right there. Let me dig into it. First, we have market risks. So, best example that I could find was Terra Luna in May 2022. There was a stable coin called USD. This was supposed to always equal $1, like just like your USDT or USDC. It starts slipping on May 9th. Within 72 hours, its sister token Luna went from $40 billion in value to basically zero. 45 to $50 billion in losses in just 3 days. It was harsh. And then we have our credit risks. June 2022, Three Arrows Capital, sorry, a huge crypto fund defaulted. That single default took down Voyager, Genesis, BlockFi, 3 billion in losses. The entire crypto lending industry just imploded. And then we have a liquidity risk. This is the one that really kills you. FTX November 2022, customers withdrew $6 billion in 72 hours. By the time the dust settled, at least $1 billion in customer money was simply missing. Bankruptcy was filed on November 11th. That's the thing about liquidity in crypto. Once people start running, you have hours, not days to respond. You have hours. That's why VARA's 100% reserve rule exists. Let's move on to operational risks. The middle column on this side is highlighted in gold for a reason. Technology risk is the defining risk in crypto. Let me tell you about Bybit. February 21st, 2025, North Korean hackers, the Lazarus Group, pulled off something genuinely clever. Bybit was using a third party tool called Safe Wallet for their multi signature approvals. The hackers got into the tool's user interface and tampered with it. So when the Bybit CEO went to approve what looked like a totally normal wallet transfer, the screen showed him the normal transaction, but the actual code being signed sent the money to the hackers right there. $1.5 billion gone. Biggest crypto theft in history. And what's terrifying about it is that Bybit did the right things. They had multi signature, they had cold storage, they had hardware security. The attack was on the human pipeline, the screen, the software showing you what you're approving. That's a new kind of risk. And we also have legal risks. Binance, November 2023, the Department of Justice fined them with $4.3 billion for failing anti-money laundering controls. And the fences piece alone, 3.4 billion, is the largest financial penalty in US Treasury history yet. The CEO stepped down and served 4 months in prison. That's what legal risk looks like when it actually hits. And of course, we have geopolitical risks. Four more risks. Um, I'll just quickly go through it. Geopolitical. September 2021, China banned crypto overnight. Binance had to pack up and find a new home. That's literally why they ended up in the UAE. Reputation, and this is wild. November 6, 2022, Binance CEO tweets that he's selling all of his FTX token. Just a tweet. FTX was bankrupt 5 days later. That's how fragile trust in this industry is. And lastly, ESG. Bitcoin uses about 0.4% of the world's electricity. That's a lot. But here's the interesting thing. When Ethereum switched its consensus mechanism in 2022, in September, it cuts its energy use by 99.95% overnight. It went from a problem to an investable asset for ESG funds pretty quickly. And terrorism financing, Lazarus Group, the North Korean hackers have stolen at least 3.4 billion in crypto since 2007. That money funds their weapons. Bybit, the Ronin bridge hack, Ronin is also a blockchain, DMM, Bitcoin, all connected. So when you're defending an exchange, you're not defending against teenagers in a basement. You're defending against a nation state. It's a huge thing. Okay, now let's go through the math. I've created three models. This is the section where we go from describing risks to measuring it. First model is the maturity gap. This comes straight from banking, and the idea is very simple. You add up everything in your business that earns or pays interest. The difference between what earns and what pays is your gap. Multiply that gap by interest rate exchanges, and you get how much your profit moves. In crypto, what earns interests? It's margin loans to traders, T bills that back stable coins like Tether, DeFi deposits. Here, what pays interest? Customer yield accounts, institutional borrowing, floating rate stablecoin deposits. And if you look at the right in the example, this exchange has 5.5 billion in interest earning stuff and 4.4 billion in interest paying. So the gap is plus 1.2 billion. They are what we call asset sensitive. What does that mean practically? If the Fed raises rates by 1%, they make an extra 12 million a year. But if the Fed rates cuts back, they lose 12 million. So they should be hedging that exposure, usually with futures. Now let's look at the second model, maturity ladder again. Um, This is for liquidity, and honestly, is the most important model for an exchange because liquidity is what kills you. It's not solvency. The idea is you forecast cash inflows and outflows over time, um, be it in the next 24 hours, next week, next month. And if the cumulative net ever goes negative, you genuinely have a problem. I want to show you the FTX collapse through this lens. Look at this table. Day zero, the league balance sheet hits the news. FTX still has 1.5 billion in surplus liquid assets. They're fine. Day 1 to 2. The CEO of Binance tweets, panic erupts, withdrawals jump from um, 1.5 billion to 2.5 billion. Suddenly, they are 1 billion in short, but still cumulatively positive. Day 3, they start freezing withdrawals, and here's the killer. Their reserves were mostly held in FTT, that is the FTX token, their own token. And when confidence collapsed, FTT crashed 90%. This is something that I saw. The reserves, they were evaporated. There were no reserves because the token crashed. Cumulative gap is now negative 1.7 billion. By day 5, the hole was over 8 billion. And by day 9, they declared bankruptcy. So the lesson here is you can never count your own token as a reserve asset. It's circular. And that's exactly what VARA's reserve audit catches. The third model, expected credit loss, this comes from IFRS 9 accounting standards. The formula is three terms: um, probability of default times loss given default times exposure at default. Now, probability of default. How likely is it they don't pay? Loss of default. If they don't pay, how much do you actually lose after recoveries? And exposure at default. How much did you lend them in the first place? In crypto, each piece has a twist. Probability of default isn't driven by the borrower's salary or business performance, it's driven by how volatile their collateral is. Loss given default isn't 30% like a mortgage. In thin crypto markets, when you try to liquidate, you lose 50 to 60, sometimes even 80% just to slippage. Anybody who's worked in the crypto markets has seen it right in front of their eyes. IFRS 9 sorts loans into three stages: healthy, getting worse, defaulted. The table shows a 1.7 billion loan book. Total provision about 92 million or 5.4% of the book. But if you look closely, you'll watch what happens when you stress test it. If Bitcoin drops 40%, a bunch of stage 2 loans become stage 3. Slippage gets worse, and the provision jumps to 250 million, almost three times bigger. That's the number the board needs to be able to absorb. And speaking of stress testing, I've created four scenarios, and every one of these is collaborated against something that actually happened. Scenario one: Bitcoin drops 50% in a week. Response: tighten margin requirements, auto deleverage, draw on the insurance fund. Scenario 2: cold wallet gets hacked. Billion plus stolen. That's Bybit actually. Response: freeze the chain. Insurance funds make customers whole, get the FBI and and start the chain analysis tracing. Scenario 3: a major country bans crypto. That's China 2021. Response: geofence affected users in 72 hours. Root flows to compliant jurisdiction like the UAE. They move to UAE. And the scenario 4 is the FTX scam scenario. Mass withdrawals. Response is everything is critical, never pause, but exchange should never pause withdrawals selectively. That triggers exactly the panic you're trying to stop. Instead, publish proof of reserves immediately or ride it out. Now, Here's the standard risk matrix. Um, Likelihood on one side, impact on the other. We've all seen this. But the point is in the matrix. The point is where the dots cluster: cyber, liquidity, legal, reputation, market. All up in the top right corner. That's the extreme zone. 5 out of 10 risks cramped into the danger zone. For comparison, when you map a traditional bank's risk, you usually get two or three up there max. Crypto has five. That's the whole quantitative case for why crypto needs more capital and reserves buffer than Basel III prescribes for regulator banks. The risk profile is just way more denser. This is what happens. This is what a real crypto risk register looks like. There are 8 rows here. Each one has an ID, a description, a likelihood, and an impact score, a mitigation, a mitigation plan, and most importantly, a named owner. I'll just highlight three. Um, the first is R01, the hot wallet breach. Mitigation is keeping less than 2% of assets in interconnected wallets owned by the CISO. Um, R03, regulatory informants. This could be mitigated by three lines of defense plus an independent monitor, which, by the way, is exactly what DOG forced Binance to install after their settlement. And I also want you to look at the last one, that is R08, insider compromise. Low chances of this, but maximum impact. Mitigate this by multi signatures so no single person can move money alone. So every risk has a responsible person. That's how you make a framework actually work. This is what monitoring looks like in practice. Real time dashboard. Four big KPIs at the top. You look at proof of reserves at 103%. It's healthy, more assets than liabilities. Then we have NLA ratio at 2.8 times, well above the VARA minimum of 1.2%, 1.2 times. And the Bitcoin volatility at 58%, which is elevated. That triggers margin recalculations as well. And 24 hours withdrawal at 3.8%. That's a yellow alert. Below that, 15 KRIs across the risk families, a couple are yellow. Top 10 client concentration is creeping up. AML in bond is slightly elevated. The tools doing this work are chain analysis or for on-chain analytics. Splunk for security monitoring, CrowdStrike for theft detection. These are all platforms. This is operational risk management as it actually happens. It's not on a PDF file. It's in a live screen. So three pillars for when things go wrong we should be looking at. First one is recovery targets at the top. The matching engine has to be back online in under 5 minutes. You can't have a derivatives book sitting in a limbo. Pillar one, infrastructure. Two data centers running simultaneously. Probably one in UAE, one in Singapore because they're both crypto friendly. If one dies, the other takes over. Pillar two, survivable custody. Multi-signature wallets needing four of seven signatures, 4 of 7 signers. Hardware security models. 95% of assets should be in cold storage. And pillar three is capital backstop. Binance SAFU fund is about $1 billion. It's visible. It should be visible on the chain, ready to be drawn down within 6 hours of a board decision. Now, I've also created 3 tiers of wallet storage. Hot wallet connected to the internet, used for instant withdrawals. I think maximum 2% of customer assets. Any more than that is just reckless. Warm wallet, air gapped, requires 4I approval for transfer, should be 3 to 5% of assets. Cold wallet should be fully offline. Key shards distributed across at least 7 jurisdictions. And At least 95% of the customer assets should be sitting there. And the Bybit hack taught us this. Even cold wallets aren't bulletproof. If the screen showing the transaction can be tampered with, it does not matter how secure the keys are. So, the new standard is hardware isolated displays that decode transaction data independently. You're verifying what's actually being signed, not what some piece of software claims you're signing. So, all of this sits inside frameworks. Um, ISO, NIST, VARA's tech rulebook. These are all our layered defenses. Derivatives are a big thing in crypto, and they play two completely different roles for an exchange. First, as a product you sell to the customers. Perpetual futures, options, CFDs. VARA caps the leverage on these at 5 to 1 for retail under their 2025 rulebook. But second, and this is the more interesting use, as a hedge for the exchange itself, if Binance is holding billions of customers' Bitcoin in custody, they're exposed to Bitcoin's price. So they short an equivalent amount of dated futures. Now, their economic exposure is roughly zero, regardless of what Bitcoin does. The trick is you have to hedge for basis risk, not just direction. The gap between spot and futures can blow out in fast markets, very fast. And that's where badly hedged exchanges get hurt. So, okay, moving on to my favorite slide. This is the slide I care about the most. Two concepts. A black swan is Talib's idea, an event that's unforeseeable and an outlier with massive impact. Something like the Bybit hack qualifies. Genuinely novel attack vector, no playbook for it. And a gray rhino, a risk that's huge, obvious, and ignored. Here's the thing. Most of what people call black swans in crypto were actually gray rhinos. FTX, the balance sheet leaked on November 2nd. The whole industry watched it die over 9 days. That's not unforeseeable. That's unforeseen because nobody wanted to look. Terra, economics were publicly warning about the algorithm's stable design for at least a year before it collapsed. And what's the lesson here? And this is one thing I want you to take from this whole presentation. Good risk management spends more time on gray rhinos than black swans because most disasters that get called unprecedented actually had a sticky note on the wall the whole time. People just chose not to read it. It's a big take. And moving on to the conclusion, here are my takeaways. Crypto risk isn't new. Let's be very honest. It's just banking risk, faster, meaner, and on steroids. Tech and liquidity together caused most of the damage in the last few years. Most unforeseen crashes were grey rhinos. The UAE has built the world's best regulatory system I've seen so far, and risk management itself has become the competitive advantage. The exchanges with proper frameworks will be the ones that survive. So, if I leave you with one thought, it's this: crypto exchanges that survive the next decade are going to look almost identical to traditional banks. Same governance, same monitoring, same buffers. The only real difference is what they custody. Thank you very much. I'm happy to take your questions now.